Most people believe wealth is built in big moments: a breakthrough investment, a viral business launch, a perfect market entry. That belief is comforting, because if wealth depends on rare events, then the reason you are not ahead yet must be timing. But this is the trap. The wealthy are not ahead because of rare moments. They are ahead because of repeated micro-decisions that compound invisibly. And the most dangerous part, you cannot see these decisions from the outside. Like you see the car, you see the house, you see the headlines. You do not see the daily behavioral architecture that created them. This is where the structure reveals itself. Wealth does not behave like a lottery. It behaves like gravity: invisible, constant, unforgiving. Gravity does not reward effort. It rewards alignment. Step off a building, and gravity does not care about your intentions. Misalign your financial habits, and compounding will not care about your potential. This is not about intelligence. This is not about talent. This is about daily alignment with forces most people ignore. And here is the uncomfortable truth. Rich people are not ahead because they work harder. They are ahead because they protect 3 daily habits with ruthless consistency. Habits so small, they look insignificant. Habits so simple, they are easy to dismiss. Habits so psychologically uncomfortable that most people abandon them within weeks. But those habits alter financial trajectory at a structural level, not motivational, structural. There is a silent anxiety that follows many people around money. It shows up at night. It appears in subtle comparisons. It whispers during purchases. A quiet question: what if I am falling behind? Most people try to silence that anxiety with action. Spend more, earn more, invest faster, upgrade lifestyle. But anxiety does not disappear with activity. It disappears with control. And control is created by systems. Think of your financial life like a biological organism. Every organism survives because of automatic processes: breathing, circulation, cell repair. You do not negotiate with your lungs each morning. They operate by default. The wealthy design their financial systems the same way: daily processes that run without emotional debate. And this is where most people lose, because the average person treats money as a reaction. The wealthy treat money as a protocol. Protocol is powerful. Protocol removes drama. Protocol reduces decision fatigue. Protocol compounds. Now, here is the pattern interrupt. The 3 habits that keep rich people ahead are not about making more money. They are about controlling behavior before money ever enters the equation. This changes everything. Because if behavior drives financial outcomes more than opportunity, then waiting for opportunity is irrelevant. You're either structurally ahead right now or structurally behind. And structure is built daily. Let's dismantle another myth. Rich people have access to better investments. Sometimes. But that is not the core advantage. The core advantage is behavioral insulation. They build friction between themselves and poor decisions. They reduce exposure to impulse. They protect cognitive bandwidth. They prioritize capital preservation before capital expansion. This is why they stay ahead even when markets fall, even when businesses slow, even when industries shift. Because their edge is not situational, it is systemic. And here is the part nobody likes to admit. Most financial struggles are not caused by lack of income. They are caused by lack of daily control. You can earn 6 figures and still leak capital through invisible behaviors. Subscription creep, lifestyle inflation, status spending, reactive investing, emotional decision cycles, small leaks, daily leaks. Leaking 2% of capital velocity per day feels harmless, but compounding works in reverse too. If positive compounding is exponential growth, negative compounding is exponential erosion, and erosion is silent until it is irreversible. This is why the 3 habits matter. They are not about hype. They are about preventing erosion. And once erosion stops, growth accelerates naturally. Here is a biological metaphor most people overlook. In the human body, homeostasis maintains internal stability, temperature regulation, pH balance, hormonal equilibrium. Without homeostasis, the body collapses under external pressure. Financially, most people live without homeostasis. Their income fluctuates. Their expenses fluctuate. Their emotions fluctuate. Their decisions fluctuate. The wealthy build financial homeostasis. Daily review, daily restraint, daily positioning. And because of that stability, they can absorb external volatility without internal collapse. This is why during downturns, they acquire assets while others panic, because their internal system is stable. But we are not going to stay abstract. Over the next sections, we are going to dissect the 3 habits in surgical detail: how they operate, why they are psychologically difficult, what structural advantage they create, how they accelerate wealth velocity over time, and how they quietly separate the top 5% from everyone else. But before we reveal the first habit, understand this. These habits are not glamorous. They will not impress your friends. They will not produce instant results. They will not feel exciting. And that is exactly why they work. Because most people are addicted to visible progress. The wealthy are addicted to invisible alignment. There is a difference. Visible progress feeds ego. Invisible alignment builds power. And the 3 habits sit in that invisible space. The first habit, in particular, destroys one of the most common self-sabotage loops that keeps intelligent people financially stagnant. It removes shame. It removes chaos. It removes financial fog. But it requires something most people avoid: direct confrontation with reality. And this is where the separation begins. Section 1. The first habit that keeps rich people ahead is deceptively simple: daily financial awareness, and not budgeting in the restrictive sense, not obsessive spreadsheet micromanagement, not emotional monitoring of every fluctuation. Awareness. And the reason this habit is powerful is not because it increases income. It increases clarity. Clarity changes behavior. Behavior changes outcomes. Most people operate financially the way someone drives in heavy fog. They can see a few feet ahead. They react to what appears. They adjust only when something becomes unavoidable. But they cannot see trajectory. They cannot see drift. They cannot see compounding error. This is where the structure begins to separate. The wealthy eliminate fog. They create visibility. Daily. And visibility collapses uncertainty. Let's dismantle the first layer of illusion. People believe wealth is primarily about earning more, but earning more without awareness increases volatility. If income rises from $70,000 to $150,000 without structural awareness, a lifestyle often expands proportionally. Mortgage upgrades, vehicle upgrades, dining frequency shifts, subscription density increases, travel frequency expands. None of these decisions feel catastrophic. Individually, they appear reasonable. Collectively, they alter fixed cost structure. Fixed costs are gravity. Once elevated, they are difficult to reduce without emotional resistance. And this is where drift compounds. Drift is the silent killer of financial progress. A drift happens when spending decisions are reactive. Savings are residual. Investments are irregular. Debt is tolerated instead of measured. When someone does not look at their numbers daily, they unconsciously operate on assumption. I think I'm doing fine. I'll adjust next month. I deserve this. It's not that much. Assumption replaces precision, and assumption is expensive. Now let's quantify something rarely discussed. If a person earning $120,000 leaks $40 per day in unnoticed discretionary drift, that equals $14,600 per year. Invested at 8% annual return over 20 years, that is approximately $668,000 in lost capital. That is the cost of drift. Not one dramatic mistake, not a failed investment, not a market crash, just unnoticed daily leakage. This is the trap. Most financial damage does not look like collapse. It looks like slow erosion. Erosion does not trigger alarm. It triggers normalization. And normalization creates permanence. The wealthy prevent normalization of erosion by inserting daily friction. They look, they measure, they adjust. And that micro-adjustment loop prevents exponential loss. But awareness does something deeper. It removes shame. Shame is one of the most under-discussed financial forces. When someone avoids their bank account, they are not lazy. They are protecting self-image. Low savings threatens identity. Debt threatens competence. Is inconsistent income threatens stability. So the brain chooses avoidance. Avoidance reduces short-term discomfort, but increases long-term instability. The wealthy eliminate the avoidance loop. They confront numbers when they are small problems. Small problems are emotionally manageable. Large problems feel overwhelming. Daily awareness ensures no problem remains large for long. This changes everything. Now let's introduce a concept from control systems engineering. When closed-loop systems adjust in real time, open-loop systems wait for external correction. Most people run open-loop finances. They spend, they earn, they wait until the end of the month. Then they react. The wealthy run closed-loop systems. Spending occurs. Feedback is immediate. Adjustment happens within 24 hours. This reduces volatility amplitude. Think of it like steering correction. If a car drifts 1 inch off course and correction is instant, the deviation remains minimal. If correction is delayed for miles, you're in a different lane entirely. Daily awareness shortens deviation distance. This is why it compounds. But here is the psychological resistance. Daily awareness feels confronting. It forces acknowledgement of trade-offs. If you review your numbers daily, you cannot pretend lifestyle expansion is harmless. You cannot rationalize convenience spending as insignificant. You cannot emotionally separate purchases from long-term goals. And this is where identity friction appears. Because spending is rarely about utility. It is about emotion, reward, relief, status, belonging, control. When awareness increases, emotional spending becomes visible. Visibility reduces impulsive behavior. And this is uncomfortable. This is why most people prefer monthly reviews. Monthly reviews dilute accountability. Daily awareness intensifies it. Now here is the second layer of the habit. Wealthy individuals do not only check balances, they check ratios. Ratios reveal health. Balance alone is misleading. A $20,000 bank balance means nothing without context. But liquidity months covered? That matters. Savings rate percentage? That matters. Debt-to-income ratio? That matters. Investment contribution consistency? That matters. These are leading indicators. Leading indicators predict trajectory. Lagging indicators report history. Yet most people stare at lagging indicators, net worth snapshots, portfolio value, credit score. The wealthy monitor leading indicators daily, and leading indicators are behavior-driven. Savings rate reflects discipline. Liquidity reflects resilience. Debt ratio reflects control. Contribution consistency reflects commitment. Because they monitor these daily, micro-corrections become automatic. If savings rate dips, spending adjusts immediately. If liquidity declines below threshold, its allocation shifts. If debt ratio rises, discretionary expansion pauses. No drama, no guilt, just correction. This reduces emotional volatility during external stress. When markets drop, the wealthy do not panic because their base ratios remain intact. But here is where it becomes strategic. Daily awareness creates predictive intuition. Patterns emerge. You begin to notice which days spending spikes, which emotional states trigger purchases, or which social environments increase expenses, which months income fluctuates, which business cycles affect cash flow. This awareness becomes forecasting. Forecasting creates advantage, and advantage compounds. But the most powerful element of daily awareness is one question. If nothing changes, where does this lead in 5 years? This question forces projection. Projection removes short-term bias. Let's model this. Imagine two individuals earning identical incomes. Person A saves 5% consistently. Person B saves 20% consistently. Both invest at 8% annually. Over 25 years, Person B does not just have 4 times the capital. They have significantly more because of compounding differential. But the divergence begins quietly. In year 1, the difference feels small. In year 5, it becomes noticeable. In year 10, it becomes meaningful. In year 25, it becomes structural. This is capital velocity. And velocity is determined by daily behavior, not annual ambition. This is why awareness is foundational. Without it, velocity decays. With it, velocity accelerates. Now here is the micro cliffhanger. Daily awareness stabilizes the system, but stability alone does not create separation. The second habit is what converts stability into structural advantage, and most people sabotage it without realizing. Because once awareness increases, discomfort increases, and discomfort triggers defense mechanisms. Defense mechanisms create rationalization. Rationalization creates self-sabotage, and self-sabotage destroys trajectory. This is where intelligent people still lose. This is where emotional spending disguises itself as reward. This is where identity begins influencing financial behavior. And this is where the second habit becomes non-negotiable. Because awareness exposes truth, but truth without discipline collapses. In the next section, we expose the behavioral traps that undermine awareness, even among high earners. This is where status illusion enters. This is where emotional finance overrides logic. This is where most upwardly mobile individuals stall. And once you see it, you cannot unsee it. Section 2. The first habit created awareness. The second habit creates separation. And separation is what quietly determines who builds wealth and who just earns well. Because earning well is not rare, but preserving momentum is. Most financially capable people don't collapse from ignorance. They collapse from drift. Drift is subtle. It doesn't feel like failure. It feels like progress. New income, new environment, new standards, new expectations. And somewhere inside that progression, margin begins to shrink. Not dramatically, incrementally. That's why this habit must be daily, because drift is daily. The second habit that separates durable wealth builders from temporary earners is this: intentional friction before financial expansion. Not budgeting, not restriction. Friction. Friction slows automatic behavior. And automatic behavior is where identity quietly spends money. Let's expose something uncomfortable. When income increases, most people do not ask, "How do I optimize this?" They ask, "What does this allow me to become?" And that question is identity-driven. Our income becomes permission. Permission to upgrade. Permission to reposition socially. Permission to redefine status. The spending doesn't feel reckless, it feels aligned. But alignment with ego is not alignment with capital structure. Now we need to talk about identity inflation. When your environment shifts upward, better offices, sharper peers, more expensive conversations, your perception of normal recalibrates. And once normal moves, restraint feels like regression. You're no longer resisting temptation. You're resisting belonging. That is psychologically expensive. So instead of resisting, most people conform upward. They buy the slightly better place. They choose the slightly better option. They rationalize the slightly higher cost. And because it's slightly, it feels harmless. But wealth is built on accumulated slight differences. Slightly higher savings rate, slightly lower fixed cost, slightly more invested capital, or slightly less emotional reaction. Those slight differences compound. Now let's quantify drift. Imagine someone increases income from $120,000 to $220,000. Instead of maintaining a $70,000 lifestyle and investing the delta, they increase lifestyle to $170,000. They feel responsible. They're still saving. They're still ahead. But they locked in $100,000 of new fixed annual cost. Fixed cost is gravity. Once locked in, it demands continuous income performance. This reduces risk tolerance. It reduces optionality. It reduces strategic aggression in investing. Because now, stability matters more than growth, and that subtle psychological shift changes everything. High fixed cost structures create defensive earners. Low fixed cost structures create offensive investors. Offensive investors deploy capital during volatility. Defensive earners protect income during volatility. One builds wealth faster, the other maintains position. Now consider something even more dangerous. Is reward-triggered expansion. You close a major deal. You exceed targets. You secure a promotion. There's an internal voice that says, "You earned this." And that voice is not wrong. But if every income spike triggers structural expansion, your baseline always rises to meet your peak, which means surplus never accelerates. Acceleration requires surplus expansion. Without surplus expansion, compounding remains linear. Linear compounding feels productive. Exponential compounding creates freedom. Now let's dissect friction. Friction is a pause mechanism. Before any lifestyle expansion, the wealthy insert a delay. 30 days, 90 days, sometimes a full year. They observe whether the desire persists or fades, because many upgrades are emotional reactions to temporary stimuli. Social comparison, stress, celebration, insecurity, validation. If the desire disappears after 60 days, it was never structural. It was emotional. And emotional expansion erodes long-term velocity. Velocity is everything. Velocity determines how quickly capital converts into independent cash flow. Independent cash flow reduces reliance on earned income. Reduced reliance increases negotiation power. Negotiation power increases income quality. Income quality accelerates surplus. Surplus accelerates capital. This loop only works when friction protects margin. Now let's go deeper. Emotional finance is not about reckless purchases. It's about subtle psychological positioning. When someone upgrades to signal arrival, they are making a social investment. The return on that investment is intangible validation. But intangible validation does not compound financially. Assets do. And here is the uncomfortable truth. Many high earners prioritize social return over financial return without realizing it. Because social return is immediate, financial return is delayed. The brain prefers immediacy. The wealthy train themselves to tolerate delay. That tolerance is not personality-based. It is habitual. They practice it daily. Every time they pause before expansion. Every time they question whether this decision increases structural resilience. Every time they choose liquidity over visibility. Liquidity is invisible strength. Visibility is visible strength. One protects you. One impresses people. And those two goals rarely align perfectly. Now let's examine stress conversion. When pressure rises, the mind seeks relief. Relief can come from convenience, outsourcing more, upgrading comfort, increasing lifestyle insulation. Some upgrades are strategic, but many are reflexive. If stress automatically converts into spending, cost structure inflates during the very periods where caution is required. That's dangerous, because stress cycles often align with market volatility. When volatility rises, opportunities emerge, but only for those with preserved liquidity. Liquidity is not just cash, it is psychological flexibility. If your expenses demand full income performance, you cannot deploy aggressively. You must protect. Protection limits acceleration. Now think long-term. If two people maintain the same income for 25 years, but one increases fixed cost gradually, while the other caps lifestyle and expands investments, the difference at year 25 is not incremental. It is structural. One has freedom, the other has responsibility. Both appear successful externally. Only one has escape velocity. Escape velocity is the point where asset income meaningfully offsets earned income dependency. Most people approach it. Few cross it. Because crossing it requires years of friction against identity inflation. And that friction is uncomfortable. Daily. Now here's the key transition. Even if someone masters lifestyle friction, even if they maintain margin, even if they expand surplus consistently, there remains another invisible leak. One that quietly slows compounding even among disciplined savers. It does not come from spending. It comes from allocation behavior. And this is where many intelligent professionals believe they are optimized, but are structurally underperforming. We go there next. Margin alone is not enough. You can control spending. You can delay upgrades. You can maintain a healthy surplus and still underperform dramatically. Because surplus without intelligent allocation is idle potential. This is where disciplined earners accidentally stall. They protect capital, but they don't deploy it with intention. Let's dismantle another comfortable myth. Saving consistently guarantees wealth. It guarantees stability, not acceleration. Acceleration comes from allocation efficiency, and allocation efficiency is deeply psychological. Most people divide money into 3 emotional buckets: safety, opportunity, speculation. The problem? They mislabel them. Emergency funds become oversized. Opportunity capital becomes underfunded. Speculation becomes disguised as opportunity. This mislabeling feels conservative, but it quietly reduces capital velocity. Velocity is the rate at which money moves from earned income to productive asset to reinvested growth. When capital sits idle for comfort, velocity slows. Now, let's be precise. Safety capital is essential. Liquidity protects you from forced selling. Forced selling destroys compounding. But safety beyond structural necessity becomes drag. If your monthly fixed cost is $8,000 and you hold $300,000 in cash, earning minimal return for years, that's not safety. That's inertia. Wealth builders calculate safety thresholds deliberately. 6 months, 9 months, 12 months. Beyond that, where capital must work. Now we enter the most dangerous allocation distortion, risk perception bias. High earners often overestimate the risk of volatility and underestimate the risk of stagnation. Volatility feels painful, stagnation feels calm. But stagnation is quietly expensive. If inflation runs at 3 to 4% and your idle capital earns 1 to 2%, purchasing power erodes annually. You don't see it daily. But compounding erosion works just as effectively as compounding growth, just in reverse. To now layer in opportunity cost. If markets return 7 to 10% long-term and your capital earns 2%, the delta compounds massively over 20 to 30 years. That delta is often the difference between working by choice at 55 or needing to continue at 65. And here is the deeper psychological layer. Many intelligent professionals hoard cash not because they need it, but because cash feels powerful. Cash feels flexible. Cash feels safe. Invested capital feels exposed. Exposure triggers loss aversion. Loss aversion is wired into human neurology. Loss hurts approximately twice as much as gain pleases. So what happens? When markets dip 15%, disciplined savers hesitate to deploy. When markets rise 20%, they hesitate to enter. In both scenarios, action is delayed. Delayed action reduces participation rate. Participation rate determines compounding depth. Wealth builders pre-commit allocation rules. They do not ask, "How do I feel about the market?" They ask, "What does my structure require?" Structure overrides emotion. For example, they define an equity allocation band. If equity falls below a threshold due to market drop, they rebalance. Not because they feel confident, because the rule says so. They define automatic monthly deployment. Not because timing is perfect, because consistency beats prediction. They define asset diversification before volatility, not during it. This daily discipline of reviewing allocation structure prevents drift. Allocation drift is subtle. You start 70% equities. Market rises. Now you're 85%. Feels great. But risk exposure has shifted. Without review, structure morphs into emotional concentration. Concentration increases both upside and downside volatility. And when downside volatility hits, panic intensifies. Panic leads to selling. Selling interrupts compounding. Interruption is the real enemy. Now let's talk about income concentration risk. High earners often believe, "My career is stable. My industry is resilient. I'm too valuable to replace." Confidence is necessary. Overconfidence is expensive. When 80 to 90% of your wealth-building capacity depends on one income stream, risk is concentrated. Diversification isn't just about investments, it's about income architecture. Wealth builders think in layers: primary income, secondary scalable income, asset income, so passive residual flows. Even small secondary flows reduce psychological pressure. Reduced pressure improves decision quality. Decision quality improves allocation outcomes. This compounding loop is subtle but powerful. Now let's examine performance chasing. When someone sees a specific asset outperform, tech stocks, real estate, crypto, private equity, emotional magnetism increases. The narrative becomes persuasive. I missed the first wave. I need exposure. I can't be left behind. Late-stage entry often occurs near peak enthusiasm. This is not stupidity. It is herd psychology. Herd psychology is adaptive socially. It is destructive financially. Wealth builders avoid narrative-driven allocation. They allocate to categories, not stories. They diversify across asset classes. They rebalance systematically. They understand that no single asset class outperforms permanently. They build portfolios that survive cycles, not chase them. Now we arrive at something deeper. Even if someone controls lifestyle, even if someone allocates rationally, even if someone diversifies intelligently, there is still one structural advantage that dramatically widens separation over decades. It is not spending. It is not allocation. It is compounding depth. And compounding depth is determined by time under exposure. Not time alive. Time invested. Most people interrupt exposure repeatedly. They exit during downturns. They delay during uncertainty. They reduce during fear. Every interruption reduces compounding depth. Imagine two investors, both earning 8% annually over 30 years. Investor A stays invested continuously. Investor B misses the 10 best market days across those 30 years. Historically, missing a small number of top-performing days dramatically reduces total return. Because markets cluster rebounds during volatility, fear removes you precisely when acceleration begins. So the daily habit here becomes critical. Not checking performance obsessively, but checking structure consistently. The wealthy do not watch price daily. They review alignment daily. Alignment with allocation. Alignment with long-term thesis. Alignment with liquidity buffer. Price is noise. Structure is signal. This mindset reduces emotional whiplash. Reduced whiplash reduces exit probability. Reduced exit probability increases compounding depth. Compounding depth is the hidden multiplier. Now here's where we transition again. If lifestyle discipline protects surplus, if allocation discipline protects velocity, if exposure discipline protects compounding, there remains one final amplifier. The amplifier that turns steady growth into exponential acceleration. It has nothing to do with markets directly. It has nothing to do with spending control. It has everything to do with asymmetry. And most professionals never deliberately engineer asymmetry into their financial lives. They rely on symmetric effort for symmetric return. The wealthy don't. They design for disproportionate upside. And that's where we go next. Now we enter the layer almost no one thinks about deliberately: asymmetry. Most people build wealth symmetrically. They trade time for money. They save a portion. They invest passively. They hope compounding does the rest. There is nothing wrong with this path. It works. But it works slowly. And slow works only if behavior remains flawless for decades. The wealthy introduce asymmetry. Symmetry means limited downside with disproportionate upside. It means placing calculated bets where failure is survivable. But success is transformative. And here's the key. Asymmetry is not recklessness. It is structured optionality. Let's break that down. If 80 to 90% of your capital is in diversified, compounding assets, that foundation creates stability. But if 0% of your capital is in asymmetric exposure, You eliminate breakthrough acceleration. Now understand something subtle. Asymmetry is not about gambling. It's about positioning for nonlinear outcomes. Examples: equity in a growing business, early participation in emerging sectors, skill investments that radically increase earning power, ownership structures instead of pure compensation. Notice something. These are not random. They are proximity-based. The wealthy often place asymmetric bets in arenas where they have insight, industry knowledge, operational leverage, network advantage, timing visibility. This reduces blind risk. It converts randomness into informed probability. Now compare two individuals. Both earn $250,000. Both invest 20% into diversified portfolios. But one occasionally allocates 10% of surplus toward asymmetric opportunities within their expertise. Over 25 years, even one or two successful asymmetrical outcomes can dwarf decades of linear compounding. This is how separation becomes dramatic. But here is the psychological barrier. Asymmetry requires tolerating uncertainty. And high performers often struggle with uncertainty. They are used to competence. They are used to control. Asymmetric bets remove control. Outcome variability increases. Ego becomes exposed. So most professionals default to symmetric safety. Predictable effort, predictable return, predictable trajectory. But predictable rarely produces extraordinary. Now here's the critical constraint. Asymmetry must never endanger stability. This is where many misunderstand the concept. They concentrate too much. They leverage recklessly. They confuse conviction with overexposure. True asymmetry protects downside first. If failure would materially disrupt your base structure, the allocation is too large. Wealth builders define asymmetric allocation limits in advance. For example, no single speculative exposure exceeds 5 to 10% of liquid net worth. This ensures survivability. Survivability is the foundation of compounding. Without survival, there is no second chance. Now let's integrate all three layers of this section. Layer 1. Lifestyle friction protects margin. Layer 2. Allocation discipline protects velocity. Layer 3. Asymmetry engineering protects acceleration. When these layers operate together, wealth building shifts from reactive to strategic. But here's the uncomfortable reality. Most people operate only Layer 1. They budget. They save. They feel responsible. Few operate Layer 2 consistently. Even fewer intentionally engineer Layer 3. And that's why wealth concentration intensifies over decades. Not because opportunity is unfairly distributed, but because structure is unevenly understood. Now, we must address the final invisible leak. Time inconsistency. Even disciplined individuals oscillate. 3 years focused, 2 years distracted, 1 year reactive. These oscillations interrupt compounding. Wealth builders design systems that function during low motivation. Automation, auto-investment, predefined rebalancing, standing allocation rules. Systems reduce reliance on mood. Mood is volatile. Structure is stable. And here is the ultimate insight of Section 2. Financial superiority is rarely about earning more. It is about leaking less. Less identity expansion, less emotional allocation, less exposure interruption, less structural drift. When leaks are sealed, surplus accumulates. Velocity increases. Exposure deepens. Asymmetry amplifies. And over 20 to 30 years, the gap becomes unrecognizable. Two people start in similar positions. Time one allows small leaks daily. The other installs daily friction. The first feels successful. The second becomes independent. That independence is not dramatic. It doesn't announce itself loudly. It appears quietly one day as choice, the ability to walk away, the ability to say no, the ability to deploy capital without fear, the ability to work because you want to, not because you must. And that is the true outcome of disciplined wealth architecture. Not status, not applause, not visible luxury, structural freedom. The leverage that separates earners from builders. Section 1 created awareness. Section 2 sealed the leaks. Section 3 multiplies the engine. Because once you control lifestyle and allocate capital intelligently, the question changes. It's no longer, how do I avoid losing ground? It becomes, how do I expand faster than linear effort allows? Most professionals operate on linear scaling. More effort leads to more income. More hours leads to more output. More years leads to gradual increase. Linear effort produces respectable success, but it rarely produces independence. Independence requires leverage, and leverage is misunderstood. Leverage is not debt. Debt is one form of leverage, and often the least sophisticated one. Leverage, structurally, is any input that produces disproportionate output. If your effort increases 10%, but output increases 40%, leverage is present. Or if your effort increases 10% and output increases 9%, you are still linear. Wealth concentration happens where effort and reward detach. That detachment is engineered. Let's begin with the first form. Financial leverage, used with structural discipline debt, is neutral. Emotion weaponizes it. When someone stretches to afford a lifestyle asset, debt amplifies fragility. When someone acquires a productive asset with conservative coverage ratios and liquidity reserves, what debt compresses time? Time compression is the point. If an asset appreciates or generates yield over 20 years, strategic leverage allows you to control more of that asset sooner. But here's the rule. Most people violate. Leverage must never threaten survivability. Survivability is sacred. If a 20% downturn would force liquidation, exposure is too large. If income disruption would cause panic, leverage is misaligned. The wealthy calculate worst-case scenarios before they calculate upside. But they ask, what happens if this performs below expectation for 2 years? If the answer is temporary discomfort, acceptable. If the answer is structural damage, unacceptable. Notice the difference in thinking. Most people calculate, how much can I gain? Wealth builders calculate, how much can I lose without changing my life trajectory? This inversion preserves compounding, because compounding requires continuity. Now consider real estate as an example. Buying property at the edge of affordability feels ambitious, but it converts income into obligation. Buying property well within conservative ratios, with reserves intact, converts debt into acceleration. Same asset class, different structure. The difference is not intelligence, it's restraint. And restraint is leverage's foundation. Because leverage magnifies both discipline and recklessness. If your base structure is fragile, leverage accelerates collapse. If your base structure is stable, leverage accelerates expansion. That's why Section 2 had to exist first. But here's something deeper. Financial leverage is often overemphasized because it's visible. There are quieter forms that compound faster, which brings us to the most underrated multiplier in wealth architecture: skill leverage. Skill leverage and network leverage. Most people underestimate how violently income can compound when skill depth becomes rare. They assume markets are the main multiplier. In early and mid-career stages, they're not. You are. Your skill stack is the highest yield asset you control. Yet here's what usually happens. Someone builds competence. Income rises. Comfort increases. Learning slows. That slowdown is subtle. They're still working hard, still improving incrementally, still performing, but they stop deliberately expanding their ceiling. And income ceilings are almost always skill ceilings in disguise. Now let's break something open. There are skills that pay well, and there are skills that multiply other skills. The second category is leverage. Examples of skill leverage. Negotiation improves every transaction. Capital allocation improves every investment decision. Communication improves influence, leadership, deal flow. Systems thinking improves efficiency across domains. Strategic risk assessment improves asymmetric positioning. These skills are portable. Portable skills compound across industries, roles, and economic cycles. If you deepen a technical skill only within one environment, growth can plateau when that environment matures. But if you deepen a transferable leverage skill, every opportunity scales higher. Now let's talk about income elasticity. Income elasticity measures how responsive your income is to incremental skill improvement. If adding 10% skill depth increases income 2%, elasticity is low. If adding 10% skill depth increases income 25%, elasticity is high. High elasticity careers and roles often include ownership stakes, revenue participation, scalable products, equity-based compensation, high-level advisory positioning. Notice the pattern. When income is tied to output scale rather than fixed salary, skill leverage compounds faster. Most professionals never intentionally shift toward higher elasticity structures. They optimize within static frameworks. Safer, yet predictable. Linear. But wealth concentration happens where elasticity is high. Now here's the uncomfortable part. High leverage skills require public incompetence at first. They require visible struggle. They require ego suspension. Most high performers resist that. They prefer environments where they already look competent. But staying where you look competent caps growth. The wealthy treat temporary incompetence as an investment phase. They intentionally enter rooms where they are not the strongest. Because exposure expands capability. Capability expands earning power. Earning power expands surplus. Surplus fuels asymmetry. This compounding loop is deliberate. Now we move into something even more powerful: network leverage. This is where wealth acceleration becomes exponential. Opportunities rarely originate in public feeds. They move through proximity. Proximity to capital. Proximity to operators. Proximity to information before it becomes mainstream. Most people network transactionally. They seek extraction. What can I get? Wealth builders network positionally. How can I become valuable within this ecosystem? Value compounds reputation. Reputation compounds trust. Trust compounds opportunity access. Access is leverage. If you are invited into early-stage deals, private placements, equity opportunities, or strategic partnerships before they are broadly marketed, asymmetry increases, and asymmetry compounds. But access is earned slowly. It requires consistency, integrity, contribution, long-term orientation. This is why many high earners plateau socially. They focus entirely on upward income mobility, not lateral ecosystem mobility. Income mobility increases pay. Ecosystem mobility increases ownership exposure. Ownership exposure increases non-linear outcomes. Now consider this dynamic. If your peer group primarily optimizes for salary, you will normalize salary growth. If your peer group optimizes for ownership, you will normalize asset acquisition. Environment shifts perception of what's possible. Perception shifts action. Action shifts outcomes. This is why environment is hidden leverage. It adjusts your ambition ceiling without explicit instruction. The wealthy curate proximity intentionally. Not to signal status, but to normalize scale. So now we have financial leverage, compresses time, skill leverage, expands income elasticity. Network leverage, expands opportunity access. There is one more form that silently ties them all together. Without it, even strong individuals leak efficiency. With it, decision quality compounds. That is system leverage. And this is where discipline becomes automatic instead of exhausting. System leverage and the compounding of decision quality. There is a reason some people look calm while building aggressively. Or it's not because they feel no pressure, it's because their structure absorbs it. System leverage is the final multiplier, and it's the least glamorous. No one brags about automation. No one posts about allocation rules. No one celebrates predefined decision trees. But this is where fatigue disappears. And when fatigue disappears, judgment improves. Judgment is the hidden engine of wealth. One bad emotional decision can erase years of disciplined progress. One panic sale, or one over-leveraged bet, one ego-driven expansion. Systems exist to prevent you from being your own volatility. Let's get precise. Every financial life contains recurring decisions. How much to save, where to allocate, when to rebalance, when to evaluate new opportunities, how to assess risk, when to increase lifestyle. If each of those requires fresh willpower, you will eventually default to convenience. Convenience is expensive. The wealthy reduce discretionary friction in repeatable domains so they can preserve cognitive energy for asymmetric decisions. Automation is not laziness. It is strategic conservation. Auto investment schedules ensure participation. Predefined allocation bands trigger rebalancing without debate. Liquidity thresholds prevent overexposure. Opportunity filters eliminate emotional distractions. For example, instead of evaluating every deal emotionally, a system might require clear downside scenario modeling, defined maximum exposure percentage, liquidity preservation post-investment, independent validation before commitment. If criteria are not met, the answer is no. No rumination, no ego, no persuasion. Structure decides. This prevents opportunity overload, which is real. As network leverage increases, deal flow increases. Without system leverage, exposure becomes chaotic. Chaos increases error probability, and error probability compounds negatively. Now let's integrate everything from Section 3. Financial leverage compresses time. Skill leverage increases income elasticity. Network leverage expands opportunity access. System leverage protects decision quality. When these operate simultaneously, compounding becomes multi-layered. Income grows faster. Capital deploys faster. Opportunity quality improves. Risk remains controlled. Fatigue remains low. This is not hustle culture. This is architectural wealth building. And here's the part most people misunderstand. The wealthy are not necessarily smarter. They are structurally calmer. Calmness comes from redundancy. Liquidity redundancy. Income redundancy. Relationship redundancy. System redundancy. Redundancy reduces fear. Reduced fear improves timing. Improved timing improves outcome asymmetry. This is why wealth acceleration often appears sudden from the outside. But internally, it was layered slowly. Years of skill stacking, years of network building, years of disciplined surplus deployment, years of structured leverage restraint. Then 1 or 2 asymmetric outcomes hit, and observers call it luck. But luck disproportionately visits structured systems. Now we arrive at the deeper psychological shift. When leverage is installed correctly, something changes, and you stop asking, "How much can I earn this year?" You start asking, "What structures am I building that will earn without proportional effort?" That shift is identity level. You move from earner to allocator, from performer to owner, from reactive to strategic. And here's the subtle truth. Ownership is not just legal equity, it's control over time. When assets produce optional income, when skill commands premium positioning, when network brings inbound opportunity, when systems protect discipline, you gain optionality. Optionality is financial oxygen. Without it, every decision feels heavy. With it, decisions feel intentional. And that is the real product of leverage. Not yachts, not luxury, not applause. Control. Control over schedule. Control over exposure. Control over participation. Control over pace. The identity shift from earner to allocator up to this point, we've discussed structure, habits, margin, allocation, leverage, systems, all external. But wealth concentration doesn't finalize at the structural level. It finalizes at the identity level. Because your identity determines your default decisions under pressure, and pressure eventually arrives. Market volatility, career instability, opportunity overload, lifestyle temptation, unexpected windfalls. In those moments, you don't rise to your intentions. You fall to your identity. Most high performers identify as earners. That identity sounds strong. It feels productive. It feels powerful. But it contains a hidden ceiling. An earner thinks in terms of, how do I increase income? A builder thinks in terms of, how do I increase capital? An allocator thinks in terms of, how do I deploy capital for asymmetric control? Subtle difference, massive consequence. Let's break this apart. The earner identity and earner ties self-worth to productivity. Effort equals value. Performance equals security. If income rises, confidence rises. If income slows, anxiety rises. Even if investments exist, psychological dependence remains tied to active work. This creates invisible fragility, because income is labor-dependent, and labor is finite. Even high-income labor is finite. The earner optimizes for promotion, recognition, performance metrics, skill expansion. All good. But without identity evolution, the earner remains trapped in time exchange. They can scale income impressively, but time remains the bottleneck. The builder identity, the builder shifts focus. Income becomes fuel, not validation. The question changes from, how do I earn more this quarter? To, how do I convert surplus into productive control? Builders feel satisfaction from asset accumulation, from increasing net worth, from expanding ownership, from watching capital generate movement. This is progress. But there is still one more level. Because builders often still manage reactively. They deploy capital. They pursue opportunity. They analyze risk. Yet decisions may still be influenced by emotional cycles. Fear, excitement, overconfidence, comparison. Which brings us to the final evolution. The allocator identity allocators detach ego from individual outcomes. They think probabilistically. They do not chase certainty. They engineer exposure. An allocator understands no single deal defines trajectory. No single downturn defines failure. The no single win defines genius. Trajectory is defined by distribution of outcomes over time. This mindset eliminates emotional whiplash. Instead of asking, "Was this decision right?" they ask, "Was this decision structurally aligned?" That distinction is everything, because right decisions can produce bad short-term outcomes, and wrong decisions can produce good short-term outcomes. Earners react to outcomes. Allocators evaluate process. Process compounds. Outcome fluctuates. And now here's the psychological barrier most people never cross: control addiction. High performers are used to direct causality, effort to result. Capital allocation breaks that. You deploy, you wait, you endure variance. Variance challenges ego. Variance challenges identity. Variance challenges patience. Many retreat back to active earning because it feels controllable. But controllable does not mean scalable. The allocator learns to tolerate delayed feedback. They learn to measure life in decades, not quarters. And once that time horizon expands, behavior changes automatically. Lifestyle pressure decreases. Comparison loses intensity. Volatility loses emotional charge, because the scoreboard moved. Now the scoreboard is net asset control over time, not visible success today. The wealth stability threshold, there is a moment, and it's rarely dramatic, when someone realizes, "My investments could meaningfully support my life if necessary." That realization changes behavior. Negotiation changes. Risk tolerance recalibrates. Time allocation shifts. They begin saying no more often, not from arrogance, from optionality. Optionality reduces desperation. Reduced desperation improves decision quality. Improved decision quality compounds advantage. This is the quiet compounding of identity. Now here's something few discuss. If identity does not evolve with wealth, wealth destabilizes identity. Sudden success without psychological expansion often produces overspending, ego inflation, or reckless allocation. But gradual identity shift produces stability. The wealthy who endure across decades rarely appear dramatic. They appear steady, measured, understated. Because their confidence is not tied to visible symbols, or it's tied to structural security. The final separation: two professionals at age 45, same income, similar net worth, similar lifestyle, externally indistinguishable. One still thinks, "I need to keep performing at this level or everything collapses." The other thinks, "My capital works whether I work intensely or not." That internal difference shapes the next 20 years. One becomes increasingly cautious. The other becomes increasingly strategic. One protects position, yes, the other expands intelligently. This is why wealth divergence often accelerates later in life. Identity finally aligns with structure. And when identity aligns with structure, friction decreases. Consistency increases. Asymmetry increases. Calm increases. Calm is power, because calm allows patience. Patience allows compounding. Compounding allows freedom. And that's where this framework lands. Not in extravagance, not in extreme frugality, not in hustle mythology, but in controlled architecture. Control over margin, control over allocation, control over leverage, control over identity. When those align, wealth is not an accident. It's an outcome. The architecture of quiet dominance. By now, you've probably noticed something. None of this framework depends on brilliance. None of it depends on luck. None of it depends on being first, famous, or flashy. It depends on structure. And structure is repeatable. Let's zoom out and look at the full architecture. Layer 1. Awareness. You monitor numbers daily, not obsessively, but intentionally. You know your burn rate, your surplus, your asset base, your exposure. Clarity removes illusion. Illusion is expensive. Most financial underperformance begins with vague awareness. When you see clearly, drift becomes visible. And drift, once visible, becomes correctable. Layer 2. Friction. You delay lifestyle expansion. You protect margin. You prevent identity from inflating faster than assets. You understand that visible success is optional. Structural freedom is not. Margin is oxygen. Without oxygen, even high income suffocates. With oxygen, even moderate income compounds powerfully. Layer 3. Allocation. You don't just save. You deploy. You predefine allocation bands. You rebalance. You avoid narrative chasing. You respect liquidity. You understand that stagnation is risk. Volatility is not the enemy. Interruption is the enemy. Time under exposure is sacred. Layer 4. Leverage. You stack multipliers. Financial leverage. Measured. Skill leverage. Aggressive. Network leverage. Intentional. System leverage. Automated. You stop thinking in annual races. You start thinking in structural engines. Engines that produce disproportionate output. Engines that keep running when you rest. Layer 5. Identity. You detach ego from income. You shift from performer to allocator. You measure success in control over time. Not applause. Not comparison. Not consumption. Control. Now, here's what happens when these layers operate together over 20 to 30 years. You don't just accumulate money. You accumulate options. Options to step back. Options to pivot. Options to invest aggressively. Options to say no. Options to design your calendar. Options to absorb downturns without panic. Most people chase wealth for luxury. But luxury is a surface reward. The deeper reward is asymmetry of choice. When others must act, you can decide. When others are pressured, you're calm. When others are reactive, you're strategic. That calm advantage compounds socially and financially, because calm attracts opportunity. Panicked capital flees. Patient capital receives. The quiet truth wealth is rarely destroyed by ignorance. It's destroyed by lifestyle inflation, emotional allocation, overexposure, ego-driven leverage, identity stagnation. I remove those leaks. And average intelligence with above-average consistency wins. That's the uncomfortable truth. The wealthy are not operating on secret formulas. They are operating on fewer errors. Fewer errors compounded over decades produces extraordinary divergence. And here is the final shift. Stop asking, "How do I get rich?" Start asking, "What structures eliminate my fragility?" Fragility eliminated becomes strength. Strength compounded becomes independence. Independence maintained becomes dominance. Quiet dominance. Not loud, not flashy, not fragile, just structurally ahead. And structurally ahead always wins long term. The discipline of not self-sabotaging most financial collapse doesn't begin with catastrophe. It begins with comfort. Comfort creates overconfidence. Overconfidence creates drift. Drift reopens leaks you once sealed. And because your income is higher now, because your net worth is larger, because your circle is stronger, the mistakes scale. This is the paradox of wealth. The more margin you build, the easier it is to believe you no longer need discipline. That belief is expensive. The late-stage trap. There's a stage most disciplined builders reach. Assets are growing. Income is strong. Liquidity exists. Stress is lower. At this stage, temptation changes form. It's no longer about proving yourself. It's about amplifying yourself. Bigger deals, larger exposure, heavier leverage, more public positioning. And because prior discipline worked, confidence feels justified. But here's the structural truth. Your downside expands proportionally with your ambition. And ego creeps back quietly. Not loudly, quietly. You start bending your own rules. This one is different. I understand this sector. I can manage this exposure. Maybe you can. Maybe you can't. The issue isn't capability. It's consistency. Wealth compounds best under boring discipline. Excitement often signals risk concentration. Now, this does not mean never scaling. It means scaling within predefined guardrails. Guardrails protect long-term compounding from short-term emotion. The psychology of enough there is another shift few people consciously navigate. At some point, your lifestyle is comfortable. Your assets are meaningful. Your trajectory is strong. But the internal scoreboard keeps moving. Said why? Because comparison never stops automatically. There will always be someone richer, someone scaling faster, someone louder. If your identity is still partially tied to comparison, discipline weakens. Comparison is inflationary. It pushes exposure beyond necessity. The wealthy who endure across decades often make one quiet decision. They define enough. Not as stagnation, but as stability. Enough liquidity, enough income, enough upside exposure, enough risk. Once enough is defined, decisions simplify. You stop optimizing for maximum. You start optimizing for durability. Durability wins longer games. The long game reality compounding is fragile in the short term and unstoppable in the long term, but only if uninterrupted. The real skill is not aggressive expansion. It's uninterrupted consistency. Avoid catastrophic error. Avoid identity inflation. Avoid ego-driven exposure. Avoid emotional exits. Do that for 30 years, and mathematics does the heavy lifting. Most people don't fail from ignorance. They fail from impatience. Impatience seeks acceleration without structure. Structure seeks acceleration without fragility. The final reframe wealth is not about having more. It's about needing less control from outside forces, less dependency on employers, less dependency on markets behaving perfectly, less dependency on approval, less dependency on timing luck. When dependency shrinks, freedom expands. And freedom compounds differently than money. Money compounds numerically. Freedom compounds psychologically. And psychological freedom is what allows you to keep playing the game intelligently. So here's the distilled formula behind everything we built. Awareness eliminates illusion. Friction protects margin. Allocation increases velocity. Leverage multiplies output. Identity stabilizes behavior. Guardrails prevent self-sabotage. Layered consistently over decades, this produces something most people misunderstand. Not just wealth, stability with power, calm with scale, quiet dominance. And the people who master that rarely need to announce it. They just operate ahead. Beyond wealth, designing a life that compounds. Here's the uncomfortable twist. You can execute everything correctly. Maintain margin allocate, intelligently stack leverage, avoid self-sabotage, and still build a life that feels misaligned. Because money compounds automatically. Fulfillment doesn't. Money follows math. Meaning follows intention. And most high performers delay that question too long. The hidden cost of optimization: when someone becomes structurally excellent at wealth building, they often optimize relentlessly. Optimize returns. Optimize taxes. Optimize exposure. Optimize performance. But optimization has a shadow. It can narrow your life to metrics. And when metrics dominate identity, everything becomes comparative. Net worth comparisons, return comparisons, deal comparisons, position comparisons. Comparison is infinite. There is no finish line. So if wealth becomes the only scoreboard, satisfaction becomes asymptotic, always approaching, never arriving. The most stable, wealthy individuals eventually shift the scoreboard again, from accumulation to design. Design over default. Most lives are default settings. Career path inherited from early momentum. A lifestyle expanded from peer exposure. Investments chosen from conventional wisdom. Social circles formed by proximity. Very little is consciously designed. Wealth gives you the ability to design, but only if you pause long enough to ask, what do I actually want my days to feel like? Not my portfolio, not my reputation. My days. Because here's the quiet truth. Time is the only non-renewable asset in this architecture. Money can recover. Markets can recover. Careers can pivot. Yet time does not compound backward. So at some point, capital should serve calendar design, not the other way around. The freedom inversion: early in life, you trade time for capital. Mid-stage, you use capital to reduce dependency. Late stage, you use capital to design experience. But many people get stuck in stage 1 permanently. They win the money game, lose the life game. The wealthiest people who appear calm and grounded tend to have made a subtle shift. They stopped asking, "How much more can I build?" and started asking, "What do I want to protect?" Energy, health, relationships, creative curiosity, contribution. Once that shift happens, wealth stops being a chase. It becomes infrastructure. Infrastructure that supports a chosen rhythm. The final discipline. The final discipline is not aggressive expansion, it's intentional limitation. Choosing how much risk is enough, how much income is sufficient, how much exposure is necessary, how much ambition aligns with your values. This isn't complacency, it's calibration. Because if ambition remains uncalibrated, the game never ends, and endless games exhaust even the strong. The people who truly win long-term are not the most aggressive. They are the most aligned. Alignment between money and meaning, ambition and energy, risk and resilience, work and identity. The real compound effect. If you zoom out 40 years, the true compound effect isn't just net worth growth. It's stress avoided, conflicts reduced, freedom exercised, time reclaimed, decisions made calmly instead of desperately. That's invisible compounding, but it shapes the quality of everything else. So here's where the entire journey lands. Build structure early. Install discipline daily. Stack leverage intentionally. Shift identity gradually. Guard against ego expansion. Define enough deliberately. Design life consciously. If you do that, wealth becomes quiet. And quiet wealth is powerful because it doesn't demand attention. It just gives you control.